presentation. The flow, I'll talk about the flow, but just trying to talk about the perspective before that. The idea is to, uh, generally we work in about four domains. So those are the domains I've tried to give a perspective from. First of all, there's a financial reporting perspective, wherein what all things perhaps, if we are sitting in March, or at least whatever adjustments may be there, those can be taken care of from a financial reporting perspective. Secondly, obviously, audit being our bread and butter, there are certain implications with respect to statutory audits or tax audits, which have some reportings do have unwitting impacts on what we would do with respect to GST. So that is another angle that I've tried to cover. Apart from that, there is an there has been an attempt to, of course, cover it from a litigation and a department audit perspective, and finally a value addition perspective that we may take up. Is the mic really necessary? Can you hear me? Better to use the mic. Yeah. That being said, the flow. So how I said, the flow is. I've tried to cover it from a financials perspective only. So your P&L and your operational points I've tried to cover first. Then obviously we go to the balance sheet, and finally some master data and miscellaneous points that I've tried to cover. The intent again, this will be points that we are very much aware of. So there may be some angles somewhere wherein I've tried to at least bring a different perspective. But I'd be happy to engage more, and you bring up also points whatever you may have thought it within these points, and then that can be an interactive discussion. So coming first to P&L operations, going right from outward supply, the first point generally we think of is outward supply. When we think about outward supply, we talk about GSTR1 and our outward register. Now here begins the some litigation pointers and some pointers with regard to department audit. So what all of us may have received notices from an e-way bill perspective, especially at least pertaining to the earlier years when e-way bill had just come in new. Now, as far as that time was concerned, there may be some place to say that it was new, and fair enough, there may have been some mistakes made. Now, all the more, it is necessary to ensure that these things are aligned. Now, from a year-end perspective, we may think about having a entire reconciliation. There can be a tech base to it. It can be done from how do you say, you get your e-way data, etc. Obviously, from some API service only, because the portal may not provide. But other than that, there at the year end, perhaps it is a good exercise to extract that data and reconcile, so that at least if there are some explanations regarding some variables which have been duplicated or say inadvertently missed or something of that sort, we may be able to take a stand against those things. Perhaps add on those sales and try to nullify those by way of a credit note or something of that sort, wherein there is no place to that thread to remain open per se. So not only e-way bill, e-invoices. In fact, a practice that we personally follow is that when filing GSTR1, we do make it a point to reconcile it with whatever e-invoicing data is available on the portal. Now, perhaps that may not be a feasible exercise for everybody on a month-on-month basis, but at least annually, at the year end, perhaps this may be a good exercise. From the financial reporting angle, absolutely, this can also, as we know, open up creditors to, challenge to their ITC. So perhaps a critical year-end exercise may be we can take up e-invoicing reconciliation, so that again there may not at the year end there may not be lot of chance to fix some of the things, because your e-invoicing in certain cases will have time limits of a month or 7 days as may be applicable. But at least then, when once you are aware, you are starting to think about ways to mitigate that. So that is one exercise that I felt essential. Secondly, again, staying at outward supplies, merchant exports, a lot of the time what happens, merchant exports at 0.1%, if we are just filing returns, we may not realize that this has come into the picture, because you will not, once data is just imported from software and exported to other software and uploaded, you may not get a heads up on the sort of what percentages, etc. are gone. So from that perspective, merchant export is something, generally the documentation part leaves a little bit desired. Uh, your typical documentation, if there is an SOP, etc., or this is again from a value addition point that I would like to say, if you can get some SOPs implemented in these cases, where you have a strict deadline regarding these documents need to be in place by this time, because again, this is coming from our experience of litigation, where we have found that in some cases it is very difficult to get documents at all, and even if documents are received, then they are not exactly in a desirable state. So sometimes your names, etc., are not included in the shipping bills, etc., and then very difficult to get those incorporated. It is a hassle. Another important point here is the intimation to the vendor. Now, even if people are doing the other documentary part perhaps perfectly, this intimation to the vendors, jurisdictional officer, is something that gets missed out. So again, a value addition point, perhaps this is also a health check point wherein you either get it done, or at least you get letters filed with your vendor's jurisdiction officer. You can obviously search out the jurisdiction officer. That data will be easily available. Considering volume, sometimes it may not be very simple to get those filed. And at the end, if we go to do all of this when the notice, etc., comes up, it becomes very difficult. Now, why I say get letters perhaps filed at the end also, if you have a look at Circular 170, it does not prescribe a time limit to when you can intimate. So that's a workaround. It may not be the most ideal, some opposition may be found to it, but the wording of the circular is such that a time limit is technically not in place for it, in order for you to intimate your vendor's jurisdictional officer. Obviously, post notice, if you try to do it, then it may be difficult to take that stand that I have done your compliance, but still, stand may be taken. So that's a critical check. At least if you've not done it at that point, at the year end, these things can be taken care of. Again, now from a financial reporting perspective, accounting treatment of goods in transit. Now, this is something again that comes from e-way bills, wherein within the sort of purview of departmental audits, this is a point that can easily come up at any time, wherein you have your deliveries at the year end, your deliveries may be stuck in transit, it has reached 1/4 or 5th, something of that sort. And not really, that it's a very small, minute point, and especially in unorganized players, it may not play such a, it may not be at the front of the mind, so to speak. But taking care of these things, reconciling those stock deliveries, and properly recognizing those in your financial reports from an audit perspective, also that may be an important point when sort of we are talking about stock verification, etc. It may be crucial because once again, when you are reconciling stock, etc., these deliveries have not yet come into your hands at that point in time at the year end. So another cross-reference point for your e-bills. Letter of undertaking, now again, simple enough point, everybody knows, but I've just put it in anyway. The filing of the LUD, sometimes it is missed, sometimes it is done late, etc. Those again minor point, but then if at all they come up at the litigation stage, can be very critical. Once again, there would be a place to say that I have filed a period with a condonation letter or something of that sort, but that actually needs to be done. And the condonation may not be sort of automatic, but at least if that sort of thing is found out, that much action will try to show that it is a procedural lapse, and that can be taken that okay, it was a procedural lapse, and we have tried to remedy it, so to speak. We come to indirect incomes, wherein we talk about discounts, write-backs, and other indirect incomes. So again, if we are talking about, say, a proprietary concern, rent income from commercial rent may at times get missed. In fact, even residential rent to be reported in exempt income, etc. That these things are generally they get skipped in proprietary because at times you may not know about it also. So those few things. Other than that, treatment of discounts, write-backs, etc. A lot of the time, generally creditors, when ledgers are closed and something is not tally and it goes to a write-back or something of that sort, becomes critical because that would tantamount to non-payment again. So whether there is a place to say that then there is some credit reversal that needs to be happening, or whether it is to be treated as an income of some sort, depending upon scheme discounts, etc., or whether some ITC reversal on that count, or treatment as income. The final points that sometimes, most of the time are obvious, but sometimes do get missed out. So that's why I put the exempt incomes, as I've already said, residential rent, especially with proprietors, sometimes commercial rent, at least, people have sufficient recognition of the fact that commercial rent does entail GST and that does get covered. Actually, one additional point that I had missed out here was, again, with respect to proprietary concerns only, there are your personal savings banks, etc. Some funds that may have been received in those banks. If a proper account of that is not there, at a later stage, that may also lead to trouble. Have faced a litigation with regard to this, wherein there is a wife's account which is on which the business is running, and the wife is doing some side activity wherein she gets her payments through her GPay. And GPay is the maximum trouble you can have as a practitioner. So,
if there are separate balance sheets are prepared, like there is a personal balance sheet where the interest income and other rental income, everything is accounted for, and there is a business income, proprietary income. For that, separate books of accounts are there.
Separate bank account.
Yeah, separate bank account is also separate. There is a current account in the proprietary concern, whereas in case of savings account, where interest income and all the loans granted to some relative or friends, interest is done on that. So whether all this is also required to be considered for the purpose of exempt income?
to my mind, so sir's question is that when there are separate balance sheets for business and personal returns, whether all of the incomes appearing in the personal accounts would be required to, sort of get covered. To my mind, sir, supply is qua a registered person, and then whichever account, but there can be multiple businesses also.
So supply always has to be seen whether it's supply in the course or in furtherance of business. So if there are investments made separately, there is a savings accounts. Out of that, out of the income which has accumulated or earned income, on that they have invested. So there is an interest income. So whether one can say this is not for the furtherance of business and hence not a supply and should not be included. Though exemption is given to interest income, but that is with the like a bank. For bank is the business, or maybe NBFC. They are carrying on a business of lending and all those things. For them, it's basically a exempt income. So if something is notified as exempt income, does that mean that is required to be included as in my supply to be taken care?
Sir, so the definition of business is sometimes becomes very tricky. At least the stand taken by the department in these things, where it is wide. I think the wording is wide enough for single activity also. Maybe your investments escape it, but say residential rent, I don't know that they would sort of take that kind of a soft stand.
related to goods in transit, I think unless the goods are delivered to the buyer, the ITC won't be able to claim on that, right? So that is also to be reconciled and taken care of.
So we are coming to that in the ITC section. We'll come to that in the ITC section. Yeah, but the point well taken. I mean, business.
Yeah, so the point was that have you come across in any assessment the officers are taking a view that even separate balance sheets are there, certain income, so that is also required to be reported as a.
Not yet.
This
Not.
may be relevant where so I'm taking like when we are not registered or if turnover is say below 40 lakh.
Yeah.
But if I include my interest income which are there. In my savings account out of that and that separate balance sheet is required. So whether for the purpose of limit also
Yes.
it is a gray area basically.
Sir, I don't think then in that case we could really that would be a very risky kind of take to my mind.
Yeah, advanced units are against that.
Yeah.
So about the first point, reconciliation of GST are one with e-invoices.
Yeah.
So sometimes invoices get cancelled after a week or so. And cancellation is allowed on e-invoice portal up till only 24 hours.
Correct.
So in such a case,
Credit note.
if I don't
See, again, the whole point is that cancellations of invoice, there has to be, strictly speaking, there has to be a basis to say that there was some clerical error in the cancellation. And if there is a cancellation of order or something of that sort, I believe a credit note may be required. Now, within the ambit of the 24 hours, if you do it still, it may be fine. But the whole point of this exercise is that something had been initiated and that information is being given to the government. So, to my mind, it would be very difficult to exclude those sort of transactions.
So in the past, I have deleted a couple of invoices which were pre-populated in the GSTR one.
Yeah.
Because of e-invoices.
That data may at the back end be available to them, and as we are getting e-payment notices right now, maybe in a couple of years those things come up. Yeah.
In case if my exam income is messed up, by chance, so what is the maximum liability the officer can charge? In this, there is no GST amount to be discharged.
Right.
So what can he charge me the amount?
So it may become a question of 42, 43 reversals, number one, and incorrect disclosure. Those are the two specific
In case of rent, so there won't be any ITC reversal. ITC reversal का possibility है नहीं because no ITC has been claimed.
No, so you would have some expenses, say your filing fees, etc. Those kind of things. Some common expenses may be there with regard to premises. It will depend case to case. Probably, if there is no such ITC, then it may skip. But at least that one point, simple point remains. I don't. Again, you can always claim that there is no loss to the revenue, etc. Or what Stan sir is saying that if it has happened, then that is a good attempt to sort of consider that it's not a business, or we fit it into the definition of business. It does not stand that test. Right. So one new thing is now IMS ideally would have come up in ITC, but it's starting to show its impact here in outward supply itself. Impact of rejected credit notes. A lot of the time with IMS, you get your rejected credit notes outward intimation. You can track that particular aspect. I'm not sure what practice everybody is following, but we are adding it to sort of sales and then again getting it re-uploading, reduce sales. There are challenges, sometimes it does not get auto-populated, etc. But that exercise and the tracking of that mechanism is something that I particularly wanted to highlight because in some cases I'm sure even some of you may not be ideally adding back those rejections, and in that case that is an open thread. To my mind, that data is easily available and it would be the easiest thing for that to be a direct notice point in the coming days. Initial, again, 6 months, maybe they may take a lenient view of this, but thereafter, difficult to imagine that when there are proper notifications in place with this regard, that lenient view of this will be taken. So an important enough point, and the data is readily available. So your portal will show you what has happened with respect to your rejected credit notes, etc. Rejected invoices may not be such a big challenge because at least you have disclosed. Now, someone has under a mistake of how IMS is to be worked out actually rejected ineligible credit, which sort of ineligible to them. So those things, at least when we have our transport proofs, etc., we have our proof of supply, they may not be a challenge. But credit notes, to my mind, at least with respect to addition of the turnover to GSTR1, that is something that tracking is required in this day and age. And we may start seeing, because as to ITC aspect is getting streamlined with IMS, and even GSTR9 has a couple of improvements, we will stop seeing this trend of 2A to B notices, and they will go deeper into the data that they have, which is why I have improved the e-invoices and e-bills reconciliation as well, because these are things now we can reasonably expect that the next sort of trend of notices will go in this direction because of the kind of data available. Shall I move ahead? So we've covered outward supply, input tax credit and P&L items. So now the part with the IMS comes up where if we are disregarding IMS and just the practice of, in some cases there may still be a practice of taking whatever credit is available. Now that again leaves you open to a lot of inflation of credit is very much possible. The availment of ineligible credit also is very much possible, which was erstwhile also the case. Here, fundamentally the additional point here is that they have specifically said that no action means acceptance. And then if you are accepting and you are availing, you are not reversing. I believe that would be it would be difficult to call it an oversight and maybe a positive action. So to that end, even when we do ultimately say that okay, we will reverse this credit, it was inadvertently taken, that stand may not, that point of mistake may not be available to us because it is a positive action, because the law does expect you to actively get it reconciled, say whether I accept, reject, or keep it pending. And once that dealing of a sort of no action being acceptance is there, may be difficult to say that this was an inadvertent mistake, especially if there are greater multiples of this particular action happening. So one more important point here is the effect of circular 170. Now 170 typically asks you to avail all the credit because the state and center have to settle their accounts. You are supposed to take all the credit and reverse whatever is not sort of eligible to you in one way or the other. IMS, I'm sure how many of us do actually take an action or IMS, and otherwise also do we take action or IMS, or are we just letting it go and filling in whatever figures we want? Is everybody taking actions on IMS? So now say there is a credit which say it's a repair item where it is leading into a immovable item. Say it is paint, for example. Do you reject it or do you accept it and then reverse it? So 170 very clearly requires you to accept it and then reverse it. Rejection would mean that this supply does not belong to me. Then it is another great big can of worms. Because then your supplier also might run into trouble. He would probably, you don't know what direction they are going to take. He may have to probably, sort of prove his supply to you. So, from an accounting aspect, recognition of this credit for your GST, like now this may be applicable to sort of the organized players or the listed players or something of that sort, where their GLs would require to be tallied with whatever input ledgers, and to that end, recognition of this credit and subsequent reversal and expensing of of that credit may be required. So this is from a financial reporting perspective that I said that according to if you are following circular 170 and there is acceptance and subsequent reversal, whether accounting of that would also follow the same chain or not, that is something to be thought about. And if anybody has some thoughts about that, I'm happy to sort of hear your view also. You are accepting and then rejecting it, right? Whether the accounting also has to follow that same, whether direct expenses of that may not be the most suitable.
It can be parked in a separate account, it is
Yeah.
not available.
But not necessarily. I mean, there can be a possibility where I would account the entire invoice as an expense or an FA. My accounting will not determine my GST reporting per se, unless obviously my accounting is a determinative factor of my eligibility. Say for example, my accounts or my GST law says that if I capitalize the GST part of it, I cannot claim the credit. So to that extent, my accounting entries will still matter. But if it's a case of an ineligible ITC altogether, like you said, I may not necessarily follow the accounting pattern to replicate my GST reporting, or vice versa. I mean, my GST reporting would be different and my accounting would be different in all senses.
So typically, why I brought this point up also, when audits etc., departmental audits, departmental audits etc., like that, they do require your ITC ledgers to sort of match whatever working you put up with respect to this. So to that end, and then they won't go into the minutia of it. They will say open tally, show debit credit, match those up with what you've done, show how it matches. So that is the only reason I even brought this up. It was
Suppose
Yeah.
we will not claim that ITC, okay, and we will entirely that ITC will expenses out.
Yeah.
What we have.
So that's what I'm saying. So when we departmental audits, what are some practices that I've seen officers follow when there are voluminous data and they can't get it, it is very difficult to get into the minutia of every invoice. What they typically do is they will open up your input tax credit ledgers and see the debits and credits and ask you to explain, ask you to give an invoice level bifurcation of that. So if you have not accounted these things at
No,
there,
it is
and
already
there,
accounted, but we have expenses out. We will not.
right
claim
sir,
it.
right sir, but here you have claimed it. So when you are reversing it also, so technically it is no loss to them, but the claim, to explain the claim, if it does not appear in the register and you don't have an account of it, becomes a little difficult sometimes to explain to them.
So normally.
And when- yeah.
So normally they are expenses out, because delegate income, that's a benefit.
No, sir, it is definitely required to be expense out eventually, but I'm saying it has to go through the ITC ledger and not directly to the expense. It's a very minute point, it may not come up also, but just food for thought that these actions that we are taking on IMS, whether they have unwitting, sort of implications with respect to accounts also. In most unorganized players, once again, you will not find these
I
issues.
suppose it is a very big amount, then it is okay, some small printing and stationery, some small items are there.
Yeah.
Right? They are not sure whether they will
Right.
upload it or not.
Right. No, which is perfectly fine, sir. Again, this is just food for thought that. So the point I'm trying to sort of push through is that whether actions we are taking on the GST portal through whatever notifications, circulars, etc., they have accounting income. The whole idea is that these things are interplaying with each other.
So it is very difficult, Akash, to ask the client, because if you look at a bigger organization, which is also having tax code based accounting, typically at the PO level itself, the person generating the PO will determine whether that ITC is eligible or not. And the moment he puts an ineligible tax code, the GST would either get clubbed to the FA account or the expense account automatically. So, and therefore that entry into the GST ledger will never be possible. Because the moment that is done, then somebody has to manually again identify the list of transactions and reverse it, which is not possible in case of a lot of corporates where the ineligible ITC just does not get recorded in our ledgers, and therefore, to that extent,
Yeah.
I mean,
Yeah, fair.
as a part of the audit papers or your departmental explanations, you will have to prepare that manually for sure. But that's the only workaround available because ledgers may not have those entries. So we'll have to supplement it by giving the breakup of whatever you have reported separately.
So what we do is we download the purchase register. I had my departmental audit for 5 years. I'm in a corporate. In that ITC column, I've written yes or no because when I click no in my software, it goes to GST expense.
Right.
It doesn't go in ITC and then reverse it. So it's very difficult to manage. And my company is the turnover is very huge, and I have 9 branches.
Right.
So we give the purchase register, and they were okay for it.
Super. So again, if that's what I'm saying, I shared it sort of from one of my experiences, but fair point. That explanation, if it can be given and reasonably explained, then fair enough. That may not be required. Anyway, partial reversal of credit notes. So again, wherein the entire credit notes is not accepted by them, only a partial reversal is done. Whether that is being leaving open-ended, whether it has a further implication, that again remains a challenge. Although I have not yet come across a case of partial reversal, so at least to me, this is an exercise in sort of just.
Sir, please give the example of partial reversal of date.
So IMS allows you to reverse part of something, not the entire plan. So whether that once partial reversal has happened, what do you do with the whether it is left as an open-ended item or not, whether that supplier has to sort of confirm it or otherwise, and whether if it comes up subsequently, then whether rejection, etc. At the year end, if such an item is left as an open-ended thing, where do your ledgers stand? That is a little bit of a question.
In case of debit notes, we are facing various problems. I have issued the debit note. In balance of account, I have accounted debit note. Now on portal, I am not able to see the credit note. So then what should be my stand? Should I carry forward the debit note? Should I wait for the credit note to be uploaded? Or what should be the treatment to be done in case of GST 3B?
So again, when you're finalizing your accounts, this is a very routine point that comes.
Even year-end debit notes are same way. Suppose March may we have booked debit notes on the portals till March are not able to see the credit note. So what impact should be given to those debit notes?
See, at least if up to September, etc., they have come up, then you can reasonably say that okay, these have been uploaded. If up to September something has not come up, then it becomes very tricky. Then there is a fine line to be walked in terms of being right and being conservative. That this is what, if you remember, we spoke about a little while ago, when then reversal and reclaim ledger. Now, reversal and reclaim ledger may have impacted to 170. It may have impacted to 37, and it may have some impact due to items which ideally we should have kept pending, but we do not keep it pending. We availed and we did a temporary reversal, and subsequently then availment is pending. Now these may be older than your 16.4 timelines. So then whether those also need an evaluation, to my mind, yes. To my mind, reversal and reclaim ledger also, insofar as it does not pertain to 37, would require a review in terms of what line items are reviewed. So an invoice level working off your reversal and reclaim also may be required to be kept at any point in time. Again, typically we would be doing these things, but just the 16.4 aspect is something that we want to buy. Obviously, accounting accordingly also may need to be aligned. some items that are typically missed for reversal, free samples, business promotion, and other such values. Wherein business promotion is a very vague term, and we have taken shelter under that in earlier days, but they do in department audits. These are the first things that will attract their eye and the easiest place for them to ask for reversals. Free sample distribution obviously comes out of even exhibition. When they say exhibition expenses, etc., they sort of see that sort of a thing. These are things that draw the eye very easily from an audit perspective, so a department audit perspective. So, couple of things to look at here. And obviously your ISD and cross-charge compliances, especially with respect to how reverse charge has been done. You pay to your regular issue an invoice to your ISD, then again distribute from there. These are challenging things. So again, once again, the minutiae of these just wanted to highlight. ITC 04 filing. Now ITC 04 filing was, when I was contemplating this and I thought about what interpret could be there, one thing that came to mind was TDS returns may be the easiest place for an officer to verify your ITC 04 filings. So aligning both those things, although how much alignment could be there, maybe some sort of a time frame alignment, at least with respect to goods coming in and going out, and then the vendors' respective bills accordingly. That may be something that can be done as an exercise to make sure this is aligned, because typically I don't know, I thought of this right now, I haven't come across it, but now that I've thought of it, it seems to me they be a very easy place to check and cross verify. Now ITC 194C or whatever current section 1023 or 24, whatever is the code, may not be applicable to all transactions, but then it may be a good judgment point for them to sort of say, okay, this is what has been filed and this is what I can see in your, these things don't tally, so reconcile it for me. Very easy place. Similarly, another income tax implication that again, this was suggested to me by someone, a fairly good point is 15 CACV, cross-verifying that against import of services. Again, a simple enough exercise, so they typically call for this also. So, in fact, your e-way bills may be a point of cross-verification for transport expenses. You don't know how these things are going to be called. So just food for thought in terms that we also have data available, and sort of our thinking now should develop in the direction that they are going. That this is one cross-reference point that they are going to catch hold of. This is streamlining of the regular filings, etc. Proper business points like these are typically, at least to my mind, going to dominate most of the business companies. Discounts received, balances written off, etc. Again, simple enough points. What has happened with respect to GST, whether it is regard to reversal, whether it is a financial credit note, things of those sorts. 40 to 43 reversal. I think documenting a policy with respect to categorization of common expenses, that would be a very good validation exercise. Wherein if you can demonstrably show that this is a policy that we have followed with respect to, and if you can put it into some place within the notes of accounts or something of that sort. I don't know how much that is feasible. But if this exercise can be followed, 40 to 43 verifications could be the smoothest thing you do. So to that end, some sort of an SOP in this place, wherein this is again from the department audit perspective, wherein they come in and you have a ready point to show them, okay, this is the mechanism that we are following. If you show them 2-3 points where you have automated or mechanized something to a point, then deeper digging to that end may not seem feasible to them. Purchase of metal scrap, another point. So TDS on inward supply from, yeah. So again, recognition of GST, TDS, etc. Whether these things are in metals. So scrap is something again that escapes the eye. In many times it is not at the forefront of our minds. But with the coming in of RCM provisions and TDS, in fact, I still know of people who till this date have not taken a TDS registration or are not following RCM for a very difficult time. That was one thing. Then availment of ITC on goods on transit. So what Mahendra was sort of suggesting that e-bills, as I said, goods in transit for outward supply, similarly for inward supply. Your if the goods are not received by your end, availment of the credit needs to be deferred. So to that end, again a reconciliation there may be possible, and if that is kept, again it would smooth out a lot of verifications after the credit. So we moved out of the P&L. Can I move forward to the balance sheet? Is there something you'd like to address? Okay. Asset side, beginning with asset side. So fixed assets, to review the nature and eligibility of some of the sort of credits that may have been claimed. Cross verification of this can be, so if you're maintaining a check with regard to what ITC on fixed assets you have been available, there is a list etc. available. Cross verification with Schedule 3 and income tax audit report. These are simple enough items. Again, which will provide backing at a department audit or litigation stage also. Capitalization versus availment. Again, simple enough check. Disposal of fixed assets. Now, disposal also a lot of the times reversal or, for that matter, addition to liability is something that at times get missed out. So, sort of working of ending useful life at any stage, or at least a review once you dispose of an asset, a review of the ending useful life in GST terms may be required for either reversal or for addition to liability. Goods in transit, again, same thing, e-bills. GST, TDS, and TCS and accounting for this. Now, a lot of the times, GST, TDS, and TCS, if you are not, sort of filing within the routine, because let's face it, if the amounts are not significant, it gets missed out in accounting also sometimes, and sometimes, altogether, one fine day come and realize that this has been missed out. So, a review of maybe a filter of transactions wherein these TDS and TCS will be applicable, and then a subsequent availment and recognition of the same in the accounts. In fact, your ledger also to that end will only tally after these, so that may be a critical point. Again, unorganized players where you don't maintain accounts, etc. Easiest thing to escape. Check credit balance of debtors. Again, simple enough for services. Credit balance, advances, etc. May sort of need an alignment with your outward supply, the tax discharge on advances. So something on that end also. On the liabilities side, creditors. Now, creditors, there are a lot of points of cross verification. So your MSME 1 form of ROC, your 43BH reporting in income tax. Typically, when we talk about 180 days criteria, when we talk about Rule 37, we are asked to give, in some places, you give an entire ITC register and then plot dates of payment. And many a times it's not possible, except, or at least to them also it is difficult. This is an easy checkpoint. They will not rely on us. With these couple of forms, they will not rely on us with respect to dates that have been missed out. Now, 43BH, I understand it is just 45 days, but at least it will give them a start. It will filter out a lot of things for them. Then their assessment can be targeted. And MSME forms, so then there is no escaping. So that is another consideration. Credit notes. This was something that Nearby had shared with me and I found very interesting. Your proviso to section 34.2 requires a reduction of ITC on the part of your recipient. Now, whether simple ledger confirmations would suffice or whether you would need an additional confirmation. Whether a simple ledger confirmation would mean that ITC reversal has been done on their end. To my mind, it would be a good exercise to ask for an additional confirmation of ITC reversal also. As Nearby rightly pointed out that day. So it may be a good paper because when we say that transaction has been recorded by them, but until and unless they have not actually done the reversal, difficult to say that then I have done my due compliance.
I have to take a stand that since they have not reversed it in IMS, that is an automatic reversal.
Sorry?
If they have not reversed in IMS, can that be considered an automatic reversal? The credit note that I have entered.
Yes. So if they have not accepted, rejected, or fair, but again you don't know whether they are availment and reversal. It may not be exactly mappable to the IMS. There may be additional pointers which you may not know. So yes, absolutely, that they are not taking an action is a good stand for me, but it may not be conclusive. So this can be a good additional exercise. Just to highlight what Mihir is saying is that just from the fact that we do get a review of what they have done in the outward IMS side, and they have not taken any action or accepted. If that is the case, that should be proof enough. But see, to be still editable. So you can't, at least it would not be that conclusive. It is a good point to say that whatever cross-check points I have taken into consideration. That may be a good place to say. But to my mind, that would save you from, if the department decides, then to my mind, that would save you from penalty, not from addition to liability. Even with confirmations, you don't know that they are going to accept, obviously, but a good additional point to keep in mind. Your taxpayer communication tab, I don't know, some of us may have started using that. That is your best friend. With terms of, with respect to recovery also, with respect to your, this also, your unobtained ITC, someone may have not filed, etc. And if you have got communication from somewhere, that is a good tool for the department. So it's a worst enemy and your best friend at the same time. But a check of the taxpayer communication app is a good exercise to follow. At the year end, a cursory review of this would be a good place for you to also gauge a few things. And obviously, once you put something up on the portal, it's available to the department. So then delivery proof. So a lot of your now, since the latest proposed amendment is coming up, this may go away, but retaining of delivery proofs, especially where some one-time transactions are not regularly dealing with some registered person, and there is a risk of subsequent reversal of retrospective cancellations, etc. Maintaining of delivery proofs, etc. for these kind of transactions can be a good valuation point to say that particularly review these kind of transactions, create a filter for these kind of transactions, and at least those documents need to be reviewed very intensively outside of the regular vouching that would be done. And a financial reporting point wherein recognition of some liabilities or contingent liabilities again, this may be for proper corporate players, organized players or listed players, wherein your liabilities or even contingent liabilities. Review for an auditor, this would be a good review. Whether you get access to that or not is a very fair question, but it can be a good cross-check point if you do get access, wherein you can reasonably, if the orders are found and whether those are forming part of recognized liabilities or not, and if there are certain litigations going on, at least you can then go and review the paperwork of that particular litigation to check whether some material contingent liability has not been disclosed. So clearly, from a financial reporting perspective, also there is a place for us as auditors to sort of cross verify. And obviously, your tax audit report also requires reporting of this. So.
And one can also take a review of related party transactions
From?
from the financials. Related party.
Yeah, absolutely. So, I should have included that in my master data. Related party transactions, since they are there, then the cross verification of those ledgers and any questions with regard to valuation, etc., may be addressed at that point. So, yes, very nice question. Thank you.
Unbilled revenue and unbilled revenue at the beginning of the year, so the invoices have been raised for that adjustment of that.
Yeah. So I think that is why I put in the point for advances.
Advances will be on the other side.
Yeah.
Unbilled revenue.
Unbilled revenue. Right, sir. Now, typically, master data is something that gets very much ignored, and then there are nuisance notices. Your constitution updates easily verifiable. Easiest point for them to say you've not updated on GST. You're sending a notice. Similarly, for place of business changes, addition, deletion. I had an audit case recently where the client was into the food business. So their FSSAI license was not yet updated. Luckily, they had at least applied for it, and it had not gone through. But they are going to that level also. For us to know that actually that business is being carried out from that place, whether other licensing requirements. This is also happening in the liquor industry. We have PAC assessments, whether very, very silly point, but they are checking the P&L to see whether you have paid license fees or not. Easiest place for them to go to. So again, it is a theme that is increasingly appearing that department is now moving on beyond basic numbers-based notices and going into the depths of the business. And we also need to prepare for this. Your typical review of e-invoicing applicability, 86B, HSN digits, etc., all meant for March, ideally, but since we are discussing it right now, I thought to just add these few points. We also report, again, very minute point, but we also, in our registration, we have put in 5 goods or services. Now, some officers say that you should put your top 5 goods or services. So your product service mix, whether you want to, if there is a considerable change, whether that updation has been done or not, or whether you want to consider something of that sort or not, that may be required. And there's no timeline on these particular aspects. It's difficult for them also to say, you should have done this by this time. So it can be done at a later date, but a good review point. For this specific year, a review of the tax rate change, which is something that would be essential. This is something that I missed out altogether in earlier aspects. So I took it here at the last stage, where your big wholesale rate changes that come in. Typically, some people still, since their softwares are, still geared to output whatever goes in. So your 12% items have been going out at 12%. That becomes a challenge. So to that end, a review of the supply outward register with respect to whether that tax rate change is also sort of been taken care of or not. Your HSN reporting also would be a good starting point to check this. With that being said, that's it from my end. I've left sufficient time for Abdul or not, but thank you very much. I hope there was some value in this. Open to questions.
If I'm going for a legal case, I'm not receiving money from my customer. Do I have to reverse the ITC after certain durations? There are no provisions for that.
Do you have to reverse the ITC?
I mean, whatever output liability.
Why would you reverse output as that?
My question is, I raised an invoice. Okay, he has not given me the payment. So he is ideally supposed to reverse it after 6 months.
He is supposed to reverse it.
Do I have anything to do in my books?
No.
I have to keep it open also.
Yeah, of course, you have. That's your entire point of, sort of saying that this is receivable to me. In fact, doing anything to it in terms of reducing your liability would weaken your case. Okay, I'll hand over to Ankur now. Thank you very much.